It's finally here, the WOW Restoration Conference. Greetings from Virginia, USA. My name is Elsie Theodore, and I'm a Regional Vice President and Financial Coach. I have been honored and blessed to have been asked to come and speak with you about simple financial concepts that can help restore your finances and place you on a better financial path. This is my contact information for any of you who have financial questions, things that you're not sure of, that you need clarification on. Please reach out to me on the information that's before you. Let's get started. I'm going to be talking to you, ladies, about how money works. It's a simple, common sense guide to financial success. Okay, we're going to share with you today about how to take control of your finances. But let's talk about what you can do. If you're in debt, you can get out of debt. If you don't have enough savings, guess what? You can definitely build savings and you can get on a path to financial independence. And we're going to show you how to do that. The first thing is that we have to take control. What do we have to take control of? We've got to take control of number one, paying ourselves first. Are you spending everything you make, or are you saving some for tomorrow or for a rainy day? We've got to adjust our priorities. We have to have a pecking order to our priorities. We've got to change our thinking about finance. It's not a scary thing, it's actually fun. We need to adjust our lifestyle. Are we spending more than what we make? And if we are we adding additional income to the household? You've heard the old adage, multiple streams of income. Oh, it's really important these days. Let's avoid the credit trap. And very importantly, let's set some goals and have a specific plan on reaching them. This is what we can do. We can take control, of our futures, And there are things that you cannot control. So let's talk about that. The future of Social Security, you can't control that. But you can definitely control your savings for your retirement. You can't control your employer and what they're going to do with your job or your pay cuts or merit increases. But you can definitely control other sources of income. You can't control taxes, but you can control ways to reduce your taxes. You can't control inflation or the rising cost of goods and services, but you can definitely control the ways that you can maximize your savings, just saving more. And you cannot control the risk of single investment, but you can control the diversity of your investment choices. Let's talk about paying yourself first and what that looks like. We are educating people about the 3-account approach and how you need to build your savings. These are the 3 accounts that you need. You need an emergency fund, you need a short-term savings, and you need a long-term savings strategy. 3 basic concepts, 3 basic accounts. Let's talk about using time and consistency. It pays to invest early, to start investing early. Let's take an example. A one-time investment of $1,000 with a 9% rate of return. Let's look at the time trajectory here. If your parent invested $1,000 for you at birth, over the course of 67 years, that $1,000 at a 9% rate of return would have blossomed into $406,000. $406,000 from $1,000, not investing another penny. However, if your parent waited until you were age 16, you would only end up with $96,000. Maybe some people would say, hey, that's not bad, but I'd rather $406,000, wouldn't you? And how about if you waited until you were 40 to invest that $1,000? By the time you're 67, you would end up with $11,000. See, it is important to understand it's for us to start investing as early as possible and consistently doing so. But let's look at the high cost of waiting, okay? If your goal is to accumulate $500,000 at retirement, let's just say at age 67, if you began investing at 25, you would only need to put $89 a month away at 25. $89 a month. But if you waited 10 years, you would have to put 2 times more at $224 a month. If you waited till you're age 45, that's 7 times more at $602 a month to reach that same $500,000. But if you waited till you're age 55, you would have to put nearly $2,000. That's 21 times more, 21 more times more to reach the same $500,000 at retirement. So as you can see, ladies, it's important to not wait, to start investing as soon as you know how. Let's talk about the rule of 72. What is the rule of 72? The rule of 72 is the money rule. It's the rule to the money game. If you don't know the rule of 72, it's actually working against you. It's important for us to know what the rule of 72 so that we can have the rule of 72 working in our best interest. So what is it? See, it's a simple calculation given a specific interest rate. If you divide that rate of return into the number 72, the answer or the result is the number of years it would take for your money to double. So let's look at $10,000. If you had a $10,000 invested at a 3% yielding account, 3 divided into 72 is 24. So it would take 24 years for $10,000 to double just once to $20,000, and another 24 years to double one more time to $40,000. So now you're 48 years old, you're knocking on retirement's door, and you have $40,000. Are you hopeful and optimistic about your financial future? Probably not. Let's look at 6%. 6 into 72 is 12. Now, every 12 years, that money is doubling. And by the time you reach age 48, you'd have 160,000. A little bit better, but depending on the part of the country that you're living in, it may not last very long. Let's look at 12%. Something magical happens at double-digit rates of return. 12 into 72 is 6. That means every 6 years, that money is compounding. It is doubling. And by the time you're 48, you'd have $2.5 million, not adding anything to this account. See, it's important where we put our money because the banks are not giving us 12%, 6%, or 3%. But they are taking our money and investing it in the global economy where they're getting 3%, 6%, 12% or more. And they're giving us less than 1% back. See, go have a bank account, of course, have a bank account, have a savings account. But when it comes to your long-term wealth building money, you must invest where the banks invest, because if it's good enough for the banks, it should be good enough for you. Let's talk about the importance of rate of return. See, that one-time investment of $1,000, let's look at a 3% rate of return, 6% rate of return, or a 9% rate of return. Okay, so 9% over the course of 67 years would be 406,000. Okay, 6% would end up at 55,000. At 3%, 7,400. Ladies, I know you work hard for your money. Don't you want your money working hard for you? Let's talk about debt. Okay, this is where compounding does not benefit you. Did you know if you made a one-time $3,000 credit card purchase, and with that came an 18% interest rate and no new purchases, and made only the minimum payments to the credit card, it would take at least 10 years, 10 whole years to pay off. It took you 2 minutes to make that purchase, but 10 years to pay it off. And you would end up paying more than $2,000 in interest. So Here's your purchase at $3,000. Your interest is almost equitable to it. So you're paying $5,000 for that, whatever purchase you made. Let's talk about the differences between revolving debt and fixed debt. A lot of people don't realize there's a difference. It's important if you're gonna have some debt that it's more on the fixed side than revolving. Let's see why. See, look how revolving debt can erode your financial security. If you have revolving debt, credit cards, for example, and you have $17,000 of debt at 18%, your monthly payment is $595. And over the course of the years, it will take 17 years and 2 months to pay off, and you would have paid $12,500 in interest. But if you had a fixed debt, mortgage, a car note, same amount of money, $17,000 at 18%, same monthly payment at $595, you would end up paying $5,370 in interest, but it would take you 3 years to pay off. So it's important that when we have debt, that we pay it off very, very quickly, especially if we have revolving debt. But let's show you how you can do that. See, there's a method to paying off your bills. And oftentimes people don't pay their bills the right way. So for example, let's say you had retail card 1, credit card 2, car loan, credit card 1, and a mortgage. Your total bill payment every month for those specific bills is $27.20 every single month. See, what happens is that we often pay extra on all of our bills. What we're telling you is to target one, get rid of that, and then use the payment that you were paying on that once it's done and roll it over to the next. So for example, retail card 1, you're paying $220 per month. Now, once that bill is paid off, you freed up $220. Now, it's no time to party. You've got to take that $220 and apply it to credit card number 2. So instead of $353 that you're paying on the credit card 2, you're paying now $573. Okay? And once that bill is done, you freed up $573. Still no time to party because you're still in debt. We're going to apply that $573 onto the car note. And that car note, you're paying $11.24 instead of the $551 that you were used to paying, and so on and so forth. Why do we do it this way? Why do we debt stack this way? Okay, let's look at what a debt stacking difference makes for you. Without debt stacking, it will take 23 years to pay off. 23 years to pay off your debt. But with debt stacking, 9 years. You'd be debt-free 14 years sooner. See, without debt stacking, there is no way you would avoid paying interest. You would actually pay $130,000 of interest with the debt stacking method. Your interest paid without the debt stacking, $214,000. That's a house somewhere. With the debt stacking, $83,000 of interest. Listen, if I have to pay interest, I'd rather pay $83,000 than $214,000. And your monthly payments are still the same. How do we do that? The way that I show my clients how to pay off their debt is systematic. It's so important for us to become debt-free. Let's talk about avoiding the common credit card mistakes or credit mistakes. Not valuing your credit. Not valuing your credit. You must value your credit. You must also talk about raising your credit card limits. Okay, in some instances, that's not always the best choice. Not monitoring your credit history, not looking at what's on your credit report, okay, and not monitoring your credit score. Not knowing your own interest rates and fees on your credit card. I meet so many people who don't know what interest rates they're paying, and when I ask them to pull it up, they're shocked. I'm paying 25% on this credit card? Yes. So we've got to talk about that, ladies. And of course, we've got to talk about protection. What good is a financial plan talking about building wealth and growing a net worth, getting completely debt free without the proper life insurance. Okay? This is the importance of life insurance. How important is your car? Or how much is your car worth? Okay? Do you insure it? How much is your house worth? Do you insure that? But how much is your income worth to your loved ones when you die? Probably a lot more than your car and your house. You cannot afford not to insure your own life. We also educate people about the theory of decreasing responsibility. What's that? See, in the early years, you need a lot of coverage because you have a family, you have young children, mortgages, etc. Right? So if you died, the loss of you and the loss of your income would be totally devastating to your family. But in the early years, you have not yet built your wealth. So you don't have a lot of money. Therefore, you don't want to pay a huge premium on insurance or any insurance, right? So we educate people about buying low-cost term life insurance. And as you get older, you better have money. All right. In the later years, you may not need as much coverage because your kids are older and your mortgage is paid. See, when you're older, your debt is lower. So what's the need for life insurance then versus income or retirement income? Retirement income is more important than an insurance policy. See, these are what the experts are talking about when it comes to term life insurance. Term policies are most cost effective and can be specifically tailored to when you need your coverage. And in my opinion, there's only one kind of life insurance that makes sense for the vast majority of us, and that's term life insurance. And you can go on and over to talking to financial advisors who always talk about the importance of buying term and investing, the difference. Let's continue the discussion of investing. Deferring taxes is part of that. How do you do that? Okay, so this is some examples of deferring your income, okay, deferring taxes rather, over a 10-year, 20-year, 30-year, 40-year period and what that looks like financially. See, if you deferred your taxes, okay, on your contributions and your returns, you would have so much more money when you deferred your taxes. Just makes sense to defer taxes. Similarly, like a 401k program that you might have at your job. Let's talk about the time value of money. Again, the importance of starting early. See, individual A here, from age 22 to age 29, 7 years, they invested $5,500 per year in the global economy, in a mutual fund. So that's $5,500 per year over the course of 7 years. Their total contributions totaled about $44,000. And for the next several years, they added not a single penny more. But they ended up with $2 million. The power of investing, ladies, the power of investing. But let's look at investor B or individual B. They didn't start until they were 30. And they invested $5,500 from 30 to 67. That's 37 years. Okay? Their total contributions, $209,000. But they ended up, even so, with less, $1.8 million. See, I am exploring and imploring to you, ladies, that it's important for us to start investing early. Become an owner, not a loaner. See, when we get paid, we put our monies in the banks, and the banks invest our money in the global economy. Remember, I said earlier, if it's good enough for the banks, it's good enough for me, and it should be good enough for you. So what I teach our clients is to bypass the middleman and invest directly into the global economy. Now, I'm not telling you to pull your money out of the bank. That's not what I'm saying. But for your long-term wealth building, your serious money should be invested where you're going to get the higher rate of return. And that's only in the global economy. So let's look at investing in the bank, okay, and how much you have a guaranteed loss. So if you invested $10,000 at a 1% rate of return, at your local bank, you would earn $100 for that year. Now you've got to pay $25 in taxes, so that takes $25 away from the 100. So your net earnings is $75. So you've made $75, but you invested 10 because it's a 1% rate of return. Your resulting balance would be $10,075. Huh? But wait, inflation. Your buying power actually gets reduced to $9,700. So you actually lost buying power. Let's invest with professional management. Let's look at what that means. Investor A invested $100 in a month in a rising market. So I often get questions about, oh, is it a good time to invest? When is a good time to put money in the market? You can't time the market. It's about how much time you have in the market. So let's look at that. Investor A invests $100. The market is going up. But investor B is investing the same 100 in a more fluctuating market. Market is going up and down. So who fared better, do you think? Okay, let's look at what that looks like. See, investor A, same $100 in a rising market, got no discount. No discount. Who doesn't want a discount? No discount on the amount of money that they're putting in and the shares that they're purchasing. So they end up with 42 shares, only 42 shares. Investor B put the same amount of money, okay, but ended up with a lot more shares because they were able to buy shares on a discount when the market was lower. See, investor A purchased, okay, spent $600 and purchased 42 shares at $14 average cost. $14.19 average cost. But investor B spent the same amount of money, $600, got a lot more shares, but their average cost was $4 per share. So they paid $4.76 per share on average. Again, fluctuating market is critical to building wealth. Let's talk about the 3 Ds. The 3 Ds of investing is dollar cost averaging. We just went over, taking advantages of the highs and the lows of the market, discipline, how it's important to stay consistent and not starting and stopping, and of course, diversification. And that's where a financial advisor or investment specialist like myself can help you with diversifying your portfolio. You can do it, ladies. The path to financial independence starts with understanding a few basic concepts and implementing them. Winning the financial war is the result of winning tiny battles day to day. If you put a simple plan and follow it, you'll be amazed at the progress you're going to make. I am so excited to have been able to share what I do for families all across this nation, helping families build financial wealth, get completely debt-free, and protect their assets. Here again is my information, and I look forward to hearing more from you ladies. Thank you.